Alright, so as promised in the last video, we will talk about the 5 best option trading strategies for beginners. If you're new to the topic, this video is perfect for you. Stay tuned. Number 1. The long put. As one of the most popular ones, the long put is an options strategy where the trader buys a put expecting the stock to be below the strike price before expiration. If you don't know what puts or strike prices are, we strongly recommend you to watch our last video in which we explain the basics of options. But let's continue with the long put and when to use them best. So the long put is a useful strategy when you expect the stock to decline and you want to earn a large upside. Traders will earn a significantly better return on their investment than by short selling the stock, so a long put could be a good substitute for shorting the stock directly. The long put also limits the short seller's loss to the premium, while shorting the stock exposes the trader to uncapped losses. Okay, options trading strategy number 2. The long call. With the long call, the trader buys a call expecting the stock to be above the strike price before expiration. Here is when to use this strategy best. So the long call is much like the long put, but it pays out when the stock rises. So if you're expecting the stock to move higher, the long call is the way to go. The long call can earn a much higher percentage return than owning the stock directly. Because the trader's downside is limited to the options premium, the long call also could be a good strategy if the stock has the potential to move much higher but has the potential to move much lower too. If the stock falls, the options limited loss could be less than owning the stock directly. Alright, let's continue with the next strategy. We're pretty sure you'll like them, cause there are actually multiple scenarios it can be used in. We're talking of course about the short put. And by the way, if you like this video and want more information about personal finance, investing and the newest finance news, please consider subscribing as it helps out the channel enormously. But let's come back to the short put. In a short put, the trader sells a put expecting the stock to be higher than the strike price by expiration. This is similar to selling insurance against a stock falling below the strike price. As mentioned before, there are 2 good situations for the short put. Scenario 1. If the trader expects the stock to be above the strike price at expiration, the short put is a way to generate income by pocketing the premium. Scenario 2. The trader can use the short put to achieve a more attractive buy price on the underlying stock. If the stock doesn't move below the strike price, the trader keeps the premium and can execute the strategy again. If the stock falls below the strike, the trader buys the stock at a discount to the strike price, using the premium to reduce the net price paid. Okay, we got one more actual trading strategy that can make you tons of money if used right. The covered call. In order to create a covered call, the trader sells call options for each 100 shares of the underlying stock owned. The investor expects the stock to remain relatively flat, allowing the call to expire worthless. This allows the trader to pocket the premium without having to sell the stock at the strike price. The covered call can be an effective strategy for generating income when the investor owns the stock and expects it to remain relatively flat over the life of the option. It can also be an exit strategy for a position, with the investor selling calls for a strike price that they would be willing to receive. You're getting to pocket the extra premium then. Okay, the 5th strategy is actually more some kind of advice to all the new traders. We want to bring this up because it's something that can cost you thousands of dollars. And we don't want you to go through this as many others do. Our advice? Start off conservative. It's important to start out slow. Maybe buy one deep in the money call option on a stock you'd like to own, and then use it to observe the pricing dynamics of options and get a good feel for how a trade like this plays out over time. Or maybe sell a far out of the money covered call on one of your current holdings. It won't generate a ton of income, but the point is to learn. Alright, that's it for today's video. If you have learned something along the way, please consider subscribing and liking the video. It really means the world to us. Thank you very much and see you next time.